Hello, everyone, and welcome to the Let's Invest Real Estate podcast. Today, we've got a very, very special guest, the one and only Daniel Patton from, where are you from, Dan? What's the company name now?
Better Mortgage Select
Better
is
Mortgage Select.
yes. You said you had a special guest. I was looking around going, well, who else is coming on this podcast? I thought it was just you and I,
Yeah,
but
yeah.
no, thank you very much. It's great to be here.
Yeah, well, great to have you, man. And yeah, I mean, we've known each other for it's been a long time. We've done a lot of deals over the years, and you've helped me out extensively with my own investing and such quite a bit. I've gotten to know you guys pretty well over there. And well, like, why don't you tell us a little bit about kind of yourself and the business, and you guys have done some rebranding, and like, let's be honest, you guys are some of the biggest players in the industry, right? So.
Well, thank you for that. Yeah, so I've been doing mortgages for over 20 years now, not to date myself, but 20 years in this country, and I'd say primarily the last 15 has been focused on investor portfolios, private lending, commercial, residential, burst strategy, all the sort of investing that comes along with being a real estate investor. We created Better Mortgage Select as a bit of a sort of a higher end brand. We wanted, when you're an investor, I think you know this, that you can speak to this. As an investor, you really need to build a strong team of people around you. So we at Better Mortgage Select try to offer more of a concierge service, more of service type business for investors. Listen, when you're dealing with investors, not only is it important where you're getting the mortgages and the interest rates and things like that, but it's also important to understand every bank is a little different on how they look at investors, how they treat rental income, what documents they're going to require in order to qualify you. So, not only is it an advantage to have somebody like myself who, specializes in knowing the ins and outs of the different banks, but also service. So, being available after hours, being available on weekends, talking interest rates, in times like this, where do we think
Sure.
rates are going? What's impacting interest rates. So we try to offer sort of a full service, scope of business to an investor. We do private lending, we do commercial multifamily, like I said, residential, your standard, buy and holds, burst strategies, rent to owns, everything investor. That's really where we shine. So a little bit about myself, and we've been doing it a long time. We've been working with Rockstar for, oh man, it's been over 15 years we've been with the Rockstar team. So any investors that are working with them, and obviously guys like yourself, is super VIP in our world.
Yeah, yeah. Well, yeah, definitely. You guys have certainly been like, I'm like being part of Rockstar in a few capacities. It's very, you guys are very engaged with that group and offer a premium service for sure. I remember when before I was an agent, back when I was a Rockstar member, I remember a couple conversations in the early days. And I remember I actually got some really good advice. I was well, it's kind of a funny story. So I was with Scotiabank, and I was an investor before I was part of Rockstar. And I had a couple properties, and then I kind of got like, you kind of tap out, or you get capped. And I kept hearing these stories of these other investors buying 7 properties, 15 properties, 20 properties. And I kept going to the bank, like, and I was capped at whatever it was, 3 or something like that. And it was like, how does this work? Like, my income was good, my credit was good. And how are these other people able to get 15 properties when they're telling me that I'm done? And I came across you guys through Rockstar, and within a month, I had a pre-approval for multiple properties, and I was just like, "What the hell?" And I remember getting like, I was so bothered because I was trying to do all the things that we're told to do: go into the bank, make a relationship with the banker or mortgage specialist or whatever it is. I was taking her coffees and trying to like make a friend, right? And you kind of go
It's a
in,
good move. I
it
like
makes
it.
sense. It makes sense, right? Kind of go in every 6 months and have a little preview and all, where are we at? What should I do? Blah, blah, blah. And it just kept coming out with, you can't have any more, you're capped, you're capped, capped. Anyways, yeah, I came across you guys and I ended up buying 3 properties that year, which is just crazy because it just excelled everything so much faster when you're hitting these roadblocks. And obviously, the moral of the story is finding somebody that knows what they're doing and specializes in something. And I mean, it's the same with mortgage brokers, real estate agents for sure, accountants and lawyers and insurance guys. And it's such an interesting world that you just don't know until you're in it. And it's crazy how much more you can do when you have the right people like working with you or on your side, right?
Yeah, 100% agree. I get asked a lot, what people are starting out in real estate investing. Well, what's the first thing I should do? And that's exactly what I say is you need to start with building a very strong team of people around you.
Yeah.
I think at the top of that list is a realtor. I think you need a strong realtor coach that can help you understand prices, rental markets, understand just the overall, scope of the areas you're looking, the types of property. I think a realtor, I think a lawyer, I think obviously a financing person. It's funny, you touched on it and I mentioned it a little bit earlier. People, not everybody, but sometimes people have a misunderstanding. They have this expectation that, excuse me, that a bank wants to lend them money. Okay.
Yeah.
And, it's not that the banks don't want to do it, but they also don't love giving you hundreds of thousands of dollars for you to go and buy investment properties. That's not the business of a bank. That's why none of us have ever walked into a bank and seen signs or advertising or commercials for, hey, we want your rentals, bring them to us, we want to lend you on your rentals. Nobody's ever seen it. So why? Well, why is that? Well, think about it. The bank is a business, and the goal of the bank, on a broad sort of definition, the bank wants a lifetime of business from you. They want your lifetime of business. They'll start when you're young and they'll try to, give you bank accounts, and then they want to give you debit cards and credit cards and investments and insurance and a mortgage as part of a large plethora of product that they will offer you over a lifetime. That's the business of a bank. So if you're with, say, one of the big 5 banks and you've got all your investments, you got stuff with them and you want to go buy a rental, well, they have a program for that because they don't necessarily want you leaving them. So they have a program with qualifications that we as the applicant, if we can fit inside their little box of rules, they will lend us the money to buy our rental property. But you have to think about that. If I've got all my money at, say, Bank A, well, what's really the vested interest in, Bank B lending me that money as an investor? If the goal of the bank is to take a lifetime of business and you come to me and say, well, hey, I want to buy this rental property, and I'm looking at your application going, okay, but you don't have, number one, you don't have any business with us. You just want to borrow our hundreds of thousands of dollars at a cheap interest rate. And then you want us to leave you alone. I mean, that's basically what the investor wants. That's a tough sell to a bank. So it's hard to go to a bank in those scenarios and say, guys, use some common sense here. Client's worth a lot of money. The bank will go, well, none of that money's with us. So what good is that to us? Right. That's why they have these qualifying rules that us as the applicant, if we understand what their rules are and we understand sort of how to play the game of finance with the bank, then they will give us the money we want to acquire properties. And that's the trick, is sort of understanding what the banks want you, which box they want you to fit in order to get that money.
Yeah, no, it's so true. Cause you walk in and even I remember it's kind of a, I just remember so clearly, because I started very young. I bought my first rental when I was 21, and you walk in and you start asking questions about rental properties and they just look at you like it's like a different language. And I guess in their defense, quite often you'll see at the bank, you'll see a new teller. And 6 months later, that new teller has the front office with the label mortgage specialist. But I mean, sometimes they still live at home at their parents' house and they've never even got a mortgage themselves. So when you come in and you're asking these questions, it's just not their day to day. Like that's just not where they dabble, right? They can do it or they can get by, but the structure that you guys, I was always amazed. I just thought it was the coolest thing, like how you have this like system where it's like, okay, what do you want to do? I want to buy 5 properties. Okay, well then if that's what you want, you got to do this first, and then this, and then oh, you can't do this, but we got to do this over here. And it's just like, man, like you know, I don't even need to know what you're doing, and it doesn't like the ins and outs. You guys do it, and you do it well. So that, I mean, that's awesome.
Well,
And I remember too, yeah, no, of course, like that was a game changer. That changed the whole trajectory of my investments. Like it just changed it literally overnight. And I remember too getting
wow.
some, yeah, no, that's a big credit to you guys for sure. Um, I remember like getting a lot of bad advice too. You get a lot of bad advice from a lot of professionals, accountants, lawyers, mortgage brokers, realtors for sure. I often think that the amount of bad advice that I got in my younger years really actually held me back from where I could have been like sooner, right? And I remember kind of coming in with you guys, and I was still under the kind of like the spell of like the early years and shopping for the best rate, and that's all that mattered, right? And I remember having a conversation, and I was kind of upset. Like it was it's embarrassing to think of it now because I think about it and I was kind of pissed off, but because I was like, oh, I could have got this 0.01% better rate at some other bank. And I was talking to one of you guys, and it was just kind of like it kind of reeled me in. It was just like, listen, man, like, yeah, you can get the better rate somewhere else, but getting this slightly higher rate allows you to then turn around and go buy another property because you guys had that system. You got the system where you can do this and then this and this. And it took a little bit to kind of beat that into me. And I finally just kind of gave up and was like, yeah, whatever. And it, like, thinking about it now, what a stupid conversation on my behalf, because it was, you know,
You know what? I think I don't think it's a stupid conversation because listen, I think when you're talking interest rates and you're talking investments, it's an important conversation for sure. I mean, look, interest rates will directly impact cash flow and affordability when you're buying these properties. So it's a super important conversation. But one thing, you're absolutely right. One thing investors need to understand in all assets of investing, whether it's the real estate agent or it's the lawyer or whether you're buying a television to watch the hockey game on. I mean, you get what you pay for in life.
yeah,
And in some cases, if I came to you, Lee, and I said, well, listen, I want to buy an investment property, but the only thing that matters to me is the real estate agent that gives me the lowest commission, the lowest money back. What would you say? You'd probably a similar conversation that I would have. And that, look, there's always going to be, somebody out there, the rate shopper or the commission shopper, they're always going to exist. But if you're looking to build a long-term relationship, if you're looking to scale your portfolio, I truly believe that if there was, and listen, number one, we do get great rates. So let me just say that it's not like we're consistently higher, but one bank might be different than the other. And to your point, for somebody who's looking to scale their portfolio, in some cases, you may have to go to this bank in order to scale your portfolio where the rate is a little bit higher than maybe this bank, and so it's just broader thinking. It's a good point. It's funny. You said again earlier, you said, that when we sit down with investors, we would say, okay, well, what do you want to do? To me, and this is what I teach my sales guy, there's no easier sell when you're a sales guy. There's no easier sell in life than giving people what they want. So I think it's super important for people in my position. I'm sure you do it too. When I sit with an investor, that's the first question I ask them is, what is it you're trying to do? How many properties do you think you want to own? Are you buying resident? Like, walk me through what you're thinking and what your plan is. And then that's when the job of the mortgage broker sort of comes in, because now that's my job to figure out how to get them where they want to be. And in some cases, if they're not looking to scale their portfolio in a large sense, maybe we can put a bit more focus on getting a lower interest rate and a lower payment. On the other hand, if maybe they want to build their portfolio, maybe put less down payment down, well, then maybe there's some, there's some things that we have to give on that side. So it's really understanding all your options, working, and that's why working with the strong team is just super important. So
yeah, it's I think the biggest takeaway of that whole point is it's just there's so much, like, yeah, cash flow is important and all that kind of stuff, but in the grand scheme, it's a drop in the bucket. A point, the tiniest little interest rate like delta, but it's the big picture, it's the strategy, and that's the whole thing, right?
Look at penalties right now. You get the wrong advice right now on a penalty or on a mortgage rate, and if rates come down over time, that can really cost you. That can cost you big time. So you have to be super careful on things like that. And I'll elaborate for the audience just in case they don't, I'm moving too quickly, but just so everyone understands what I mean by that is, we're in a funny time of interest rates where the cost of the short-term money exceeds the cost of the long-term money at the banks. So the 1 year and the 2 year mortgages are going to be the most expensive, believe it or not. And the 5 year is going to give you the lowest rate that, out of the 1, 2, 3, 4, and 5. Now that's an odd time in Canada. Normally it's the other way around. The 1 year sort of have the lowest interest rate, and the 5 years are a nice combination of a low rate, but a longer term. It's a good balance. That's why people like it, but it's backwards right now. So somebody buying a 5 year fixed rate right now, you may be lured in by that's the lowest rate, and I want to lock in my payment, and who cares? I'm going to sell it in a few years anyways. I just want to get in at a low payment. Well, you have to be careful with somebody that's thinking like that, because if you're in a 5 year mortgage right now, let's just say that mortgage rate is 6%. Okay, let's just use that as an arbitrary number. Well, when you take a fixed rate, most people, whether they do or don't, you understand that the penalty is one of two things. Okay, it's either 3 months of interest, like a variable rate. If you get a variable rate, your penalty is 3 months of interest. But if it's a fixed rate, it's 3 months of interest, or what's called interest rate differential. And they say whichever is greater between the two of them, that's your penalty.
Right.
So when you lock into a 6% interest rate today, let's just say that's the 5 year. If in 2 years from now, 3 years from now, that mortgage rate, the 5 years are back down to 4.99, let's just say. Okay. Well, in simple terms, the bank, and you say, well, I want to break that mortgage. I've got enough out of it. It's gone up in equity. I'm going to sell it now. And you've got 2 years left on your fixed mortgage. The bank is going to, this is an easy breakdown, but the bank is basically going to look at what are interest rates now? What's the cost of us lending that money out today? And let's say it's 4.99% versus the money that we loaned out to you at 6%. Okay. Because we've loaned that to you at 6% and we've budgeted 5 years of that money at 6%. So now we have to calculate how much money we're going to lose over the next 2 years by having to re-lend that money out now at a lower interest rate. And we're going to charge you, the client, the penalty on that. And that's where you can start to see massive penalties. That happened, if you remember, at the beginning of COVID, when interest rates dropped. I was getting phone calls every day from people. They'd kill for the rate now, but they had 3.5%, 3.25%. And they're going, I hear fixed rates are 2.5%, 2.25%. I want to break my mortgage and get a lower rate. Well, not so fast. That's where the first thing I would say is call the bank and confirm your penalty. And most of the time, I'd say 99% of the time, once they do that, they realize that the cost of the penalty is designed so that they're not going to, so that the bank doesn't lose any money. It's not designed to help you, the client, save money. So another reminder of, the banks are a business. We like them, but they're a business.
Sure. The house always wins, right?
The house always wins. That's it. The bank is designed to give, and in their mind, look, they're saying, look, you told us 5 years at this rate. Now you want to break it. Well, this is the cost for that. So you have to understand. So literally like a simple decision like that, where maybe you put them, in a variable rate, or maybe you put them in a 1-2 year term or a 3 year term. Like the advice there from someone, who knows what they're doing could save you thousands down the road.
For sure. Yeah. They're getting the money one way or another, right? It's going to happen. So, that's kind of where that's where the idea, I was just like I want to get you on here and talk about, what do you got? What's that in the back? Is that your dog?
It's a dog. Yeah. He jumped up on, there's a couch over there. So there's
Oh, okay, okay.
he's looking for his spot in the sun.
I thought it was like a coyote out in the window or something there.
No, you know what? Though it's funny you say that. I just built a fence. I have two Chihuahuas, and I came out one morning at 6 a.m, and on my phone for whatever reason, and I heard a little rustling, and I looked up, and there was a coyote in my backyard just sitting there.
Oh,
so
wow.
I ran at it. I had a mesh fence along the back. And so the coyote was over that in like half a sec, gone, like just gone. And so I just built a massive fence around my yard to keep coyotes out.
Oh,
so
wow. Okay.
I'm very coyote conscious.
There you go. There you go. I saw you do a video on your Instagram, and I think it was the same day that I got the first notice from Scotiabank. And you kind of talked about the basically this new kind of regarding like a I think Scotia calls it a step, right?
Yeah, readvanceable mortgages.
Right. So since then, I've gotten a handful more of these notices, and I wanted to get you on the phone and just kind of ask you a little bit more about it and see if you could kind of give me some information. But then I thought, well, I might as well just ask you on here, and we can share with everybody, because I'm not going to be the only person getting these things. Apparently they're coming out quite a bit. Everyone's getting them, and I haven't heard anybody talk about it other than that one video that you did. So, like I said, I got a handful of these notices now. They keep coming in for all the properties that I have, and my understanding is that for the I'm reading it here in front of me. This is a Scotia one, so it's the Scotia total equity plan, the step. I'm sure every bank's got their own name for it, probably. But ultimately, it's like for a mortgage, and then there's a line of credit on that property. I think that's the understanding.
Yep.
So reading it is saying that they're going to be reducing the global limit to 65% of that home's value. Fair? Where previously, I mean, up until now, it's been 80%.
That's exactly right. So first and foremost, it's important to understand that this isn't a bank decision. So this isn't like Scotia or RBC deciding to do this. Okay?
Right.
This is coming from OFSI, which is the Office of the Superintendent of Financial Institutions. Okay. This is like the bank regulators.
Okay.
And they came in and they've told the banks that they are no longer able to provide readvanceable mortgages to 80% of the value of the home. And if you have that, if you have an 80%, it's going to be scaled back. So if we think about this just in simple terms, I always like to use the easy numbers here. So let's imagine there's $1 million property, and we're looking to buy this $1 million property. Well, traditionally, we would be putting 20% down. Right? Let's just say that's the number we're putting. Sure. So that's $200,000. That means we're going to be borrowing $800,000 against that $1 million home. Yeah. So traditionally, I could have set up that $800,000 mortgage in a $400,000 mortgage and a $400,000 line of credit. Okay, fully advanced, right? And as you pay down that line of credit, you can reuse the money, and it's sort of one of those products where as you pay down the mortgage, the money becomes available. Like you can leverage it to 80%.
Right.
Well, now the government has come in and said that's no longer allowed. Okay. Now, if you're leveraged to 80%, every month for the next 25 years, we are going to reduce the overall limit of your line of credit. Okay. The accessible amount. So the reaccessible amount. So if you were at 80% for the next 25 years, that's going to lower. Yeah. So that effectively the readvanceable portion can't exceed 65% of the loan amount. So if, again, $650,000 on $1 million property would be sort of the number to understand. Now, what this means is for people that have a home equity line of credit, it's going to, like you said, you're going to get a letter in the mail that says it's going to slowly be reduced by a certain dollar amount. It'll be on there over the next 25 years.
Yep.
Now, you can try to fight that by, let's say, well, I got my step 3 years ago. I got the house is worth more, and 65% of my $1.5 million house is going to be the same number, essentially. So you can go through the requalifying to try to keep everything the same, but it's going to be a slow transition. It's 25 years. And it's funny. You go ahead. Sorry, Lee.
No, that just like, it just seemed kind of weird. Like when I got it, it's like, okay, I get what they're doing, but I'm surprised that they're doing it so slow.
Like, well, yeah, I mean, I think that look, to come in and tell people right away that you're going to have to, either lock that into a mortgage, or you're going to have to, you're going to lose that, would just cause, at a time like this, would cause, chaos, potentially panic. So
like 25 years is a long time. So I mean, I'm looking at mine here, and it says, yeah, your global limit will gradually reduce to 65% over the next 25 years, and it'll be via monthly reductions of $405 to your step global limit. So I mean, that's this particular mortgage that I have.
Yeah.
And it just seems like 25 years. It just strikes me as just kind of an odd. I mean, I know they couldn't come in and just change it overnight.
It's like Chinese water torture, it's like a little drip every month on your forehead. And you're right. At first, it doesn't seem like a big deal, but if you just do the simple math on how much money you'd have available at 80% versus 65, that's where it will feel like a big difference. But you're right. It's a 25-year drip. It's going to we won't feel it right away. But, it's funny because it's interesting. So I called some banks that I deal with, because there's, I said, well, what happens after November 1st? Like, think about it from a refinance standpoint. Okay, let's imagine you've got this $1 million house, and maybe you have a $400,000 mortgage on it. You don't have a line of credit. You just have a mortgage of $400,000. Well, previously, if that house was worth $1 million, I could go get you a $400,000 HELOC. Right? Because I could leverage you to 80%. I could get you a 400K HELOC. So what happens after November 1st? Does that mean that now I can only send it in to get a $250,000 HELOC? Because if you owe 400 plus 250, that's 650, 65% of $1 million. Does that mean that you can't do it? So my understanding is no, that's not the case. This is the weird world we're in now. I will still be able to send that deal in for 80%. But every month after closing, that client's HELOC limit will be reduced. So I now have to have the conversation, Lee. If I said to you, okay, well, Lee, listen, I can get you this 400K HELOC, but understand every month it's going to be reduced. So if you max it out, you're going to have to, I believe what the bank will do is they'll take away that limit, and you'll either have an overdraw that you have to pay off right away, or again, I don't know, or they'll just leave the limit as is. And once you pay it down, then that reaccessible money will disappear. So that's for people who are currently leveraged past that 80% or at that 80%.
Yeah. I guess time will tell how it kind of shakes out and affects things. I mean, to my luck, I guess, I started this a long time ago, and I've got a handful of mortgages with lines of credits and that, and it just doesn't seem like, just because it's spanned over such a long time, it just doesn't seem like it'll really affect that much, I'm thinking. I mean, time will tell. But I know it's going to certainly make it harder for new people getting into it, doing the burrs, or any of those kinds of things. It's going to be tough, because it's just, even if, like, I think a burr would be a great example, because if you buy a property with a mortgage and you do all the work, the refinance, and then you go to the reappraisal, the refinance, and so on, that's going to drastically change the amount that they have access to. Like, the perfect burr
Well, not necessarily, because remember, you can still go
Right,
to
right,
80% in a full
right.
mortgage. That's no problem. But you're absolutely right in that if I'm budgeting for a BRRRR strategy and I'm thinking I'm going to max out my line of credit in the down payment and the reno cost, then I have to be conscious that I might max out my HELOC, and then every month I'm going to look like I'm overdrawn on that HELOC if I don't make those payments and reduce the limit. And things like that could impact your ability to qualify on the refi, because look, that stuff, if you're over the limit on credit, that can impact your credit, and that credit is a big part of a bank's willingness to lend. So things like that, you're 100%, you have to think about that stuff. But you can always refi and put it in a mortgage at 80%. That's not changing.
Right.
You just can't use the readvanceable part. It's going to be scaled back to the 65.
Yeah. Okay. Yeah, and it does say on here that you still have the option to borrow up to 80%. You just have to have have a reassessment, like a reappraisal, by the bank, just to confirm. So, like, to wrap it up, do you see it changing things drastically? I don't see any talk of like a changes to down payments. It's just more the accessible equity in the property. Do you think it's going to change things that much?
No, I mean, it can. I mean, listen, it can, depending on the amount of equity you have. Listen, it's sometimes I see it every day, right? Sometimes the difference between having 120 grand and 150 grand available on a HELOC is the difference between buying and not buying. When we're buying rentals, we have to have 20% down. In some cases, 25. You get in commercial, you have to have even more. So accessible money for sure reigns king still, and it's just a question of how close to that max do you need to be for the project. And again, another reason why you need to sit down with your coach, your realtor, you need to sit down with your finance person so you can understand all your options. But listen, from a how much is that going to impact people? I mean, listen, from a dollars and cents, you're talking like if you had like $400,000 mortgage, well, how much is it going to reduce every month? You're talking a few $100s. So is that going to impact you? You're talking over a year, that $400,000 HELOC might be down to like 394 by the end of the year, 393.
Exactly.
Overall, no, something like that may not. But if you're on the edge of that, I've only got 140, and at the end of the year, you're going to have like, 133 or something, or 135. It's just not, that can impact you. So you got to just budget. You got to be prepared for things like that.
No, it makes sense. Well, why do you think they're doing it? Have you heard anything behind the scenes, or like?
I think our country's worried about being over leveraged at this point. I think when you're looking at most banks on their variable rates, have what we would call high risk mortgages. You have amortizations that exceed 40, 50 years at a lot of these banks. I think a lot of Canadians, a lot of people in government just feel like we're over leveraging ourselves. We're a country built on debt.
Yeah.
And so, restrict that. I think they keep trying to make it tougher to qualify for a mortgage, thinking in some way that might help the real estate market. But again, it's funny because all they end up doing is just making it tougher for hardworking Canadians to qualify to buy a mortgage, whether it's an owner occupied or a rental. These rule changes don't just affect, investors. They affect everybody. People use their HELOCs for renovations. They use it to pay for things like school, for their kids. Like that's, they use it to invest. That's a tool that we as Canadians have used to help create wealth. Yeah. So when you take that away, it's not just investors. It hurts, but eventually, think about it, in 25 years from now, we're going to be looking back going, man, remember when you could get HELOCs to 80%? That was crazy. But it's funny because, listen, I started in mortgages, again, 20 years ago. Do you know you used to be able to refinance to 95%? When I started mortgages?
I know that, but
yeah, you would go through CMHC for an approval on a refinance. So, and they would charge their premium. So it was a lower premium at the time, but you could refinance and be leveraged to 97%, roughly 98%.
Yeah.
So they changed that down to 80% max. They said CMHC can't do refis, and we're not doing that. So things like this, like big changes like this, do happen. They do.
Yeah. Well, yeah, I mean, that's you hit the nail on the head there. I think, just to kind of wrap up, is basically, it's not going to fix anything. It's just going to make it harder for people to get in. Like, we already have a housing crisis, a housing shortage, and they're focusing on all the wrong things. It's just making it harder. It's not going to help get people into home ownership. It's going to make it harder, for generational wealth to pass down, and mom and dad to give their kids a loan or whatever, which I see a lot on the realtor side. The first time home buyers, the parents are going to help them, those kinds of things. It's just going to make it harder for sure.
Yeah, and I don't think the banks really care, to be honest, because when it's a universal rule, like, the banks don't love the idea. They like the interest, don't get me wrong, they like making money on the interest, but the banks just don't love the idea of giving you access to all that money to just do whatever you want with.
Yeah.
So when it's a universal rule, the banks get to kind of just say, well, look, hey, it's not our call, but we're being limited.
Yeah.
So
It is what it is, right?
It is what it is.
Okay. Well, man, I, as always, appreciate your insight, your wealth of knowledge, you guys there. So I'll be sure to, well, how can people find you? I'll add it in the show notes, but
yeah, they can email me direct. My email is daniel@bettermortgageselect.ca. Email me directly. We work quite a bit. I've got a great team of people around me, so I've got a great sales team. If it's not myself directly meeting with people, I've got a great team. But otherwise, reach out to me directly. I'm happy to set up some time to talk with any of your listeners, for sure.
Awesome, Dan. Appreciate it so much, man.
Anytime, buddy. Thank you again for having me.
All right, buddy. Thanks for answering the questions for me too.
Anytime.
All right, man. Have a good one.
See ya.
See ya.